Which U.S. banks have the highest commercial real estate risk in 2026? Imagine waking up one morning and finding out that the bank where you keep your savings is sitting on a ticking time bomb. A bomb made of office buildings, shopping malls, and apartment complexes that are losing value by the day. That's not a Hollywood movie plot. That's the reality of the U.S. banking system in 2026. Right now, nearly $1 trillion in commercial real estate debt is coming due. And the banks holding that debt are regional institutions with exposure so concentrated that it makes regulators lose sleep at night. So here's what we're going to cover in this video. First, which specific U.S. banks have the highest commercial real estate risk in 2026, and exactly why they're in the danger zone. Second, the two massive triggers that could turn this risk into a full-blown banking crisis. Third, why Wall Street giants like JP Morgan Chase are sleeping soundly while mid-sized regional banks are staring at a potential nightmare. And finally, what this all means for you, whether you're an investor, a business owner, or just someone with a bank account. Before we dive in, if you want to stay ahead of the biggest financial stories shaping our world, hit that subscribe button right now and turn on the notification bell. We break down complex topics like this so you don't have to be a Wall Street insider to understand what's really happening. Let's get into it. Chapter 1. Understanding the credit versus risk landscape. What is commercial real estate exposure? Let's start with the basics. Commercial real estate exposure or credit exposure is simply how much money a bank has lent out for commercial properties. These are loans for office buildings, apartment complexes, shopping malls, hotels, and industrial warehouses. Now, here's the thing. Lending for commercial real estate is a normal, healthy part of banking. Banks make money from the interest on these loans. Property developers and investors get the capital they need. Everyone wins. But there's a catch. When a bank puts too many of its eggs in the credit basket, and that basket starts to crack, the entire bank can come crashing down. The 300% rule. Regulators have a simple rule of thumb. If a bank's total credit loan exposure exceeds 300% of its Tier 1 capital, that's the bank's core equity. It's considered excessively concentrated and enters what they call heightened review territory. Think of it this way, Tier 1 capital is the bank's own money. Its cushion, its safety net. If a bank has $1 billion in Tier 1 capital, and it's lent out $3.5 billion in commercial real estate loans, that's 350% exposure. If just 10% of those loans go bad, the bank loses $350 million. That is over a third of its entire cushion. That's the kind of math that keeps FDIC examiners up at night. The big picture in 2026. Here's where things get really interesting. According to the Mortgage Bankers Association, approximately $875 billion in commercial and multifamily mortgages are scheduled to mature in 2026. That's 17% of the roughly $5 trillion in total outstanding credit debt in the United States. Now, under normal circumstances, this wouldn't be a problem. Borrowers would simply borrow a new loan to pay off the old loan and life goes on. But these aren't normal circumstances. Most of these maturing loans were originated back in 2016 or earlier, when interest rates were at historic lows. Borrowers who locked in rates around 3% to 4% are now facing refinancing rates that are 200 to 300 basis points higher. That means a borrower who was paying $300,000 a year in interest might now be facing $500,000 or more. For properties that haven't increased their rental income enough to cover that gap, there's a serious problem. The delinquency picture. S&P Global Market Intelligence reports that credit loan delinquencies across U.S. banks held relatively flat at 1.53% in the first quarter of 2026. On the surface, that doesn't sound too bad. Before 2020, delinquency rates typically hovered around 0.6%, so we're definitely elevated but not catastrophic. However, as one analyst put it, if you have 300% of your capital in office, that's a red flag, over-concentration of loan. That's exactly the problem. The risk isn't spread evenly across the banking system. It's concentrated in a relatively small group of regional and community banks that have gone all in on credit lending. Chapter 2. The high-risk banks. WHO they are and why. Let's get specific. Which banks are carrying the heaviest credit burden in 2026? I'm going to walk you through the major players, ranked roughly from highest concentration to lowest, and explain exactly why each one is in the danger zone. 1. Flagstar Bank, formerly New York Community Bancorp, assets, approximately $97 billion. Credit to equity exposure, approximately 365%. down from over 500% in 2024. Status: high risk, but improving. Flagstar Bank, which is the rebranded name of New York Community Bancorp, NYCB, has been the poster child for credit risk in the U.S. banking system. In the first quarter of 2024, Flagstar's credit concentration exceeded 500% of capital. That's 5 times their core equity. Since then, management has been on a turnaround mission. They've reduced credit concentration to about 365%, increased their CET1 capital ratio to 13.2%, and boosted liquidity from $6.5 billion to $27.5 billion. But here's the thing. Even at 365%, they're still well above the 300% regulatory threshold. And credit loans still make up 57.1% of their total loans portfolio and 39.8% of total assets portfolio. Why are they risky? Flagstar was heavily concentrated in multifamily lending, particularly rent-regulated multifamily in New York. That's a property type that's been under significant pressure due to rent control laws, rising operating costs, and soft demand in urban centers. What are they doing about it? The bank is aggressively shifting toward a more balanced portfolio. Roughly 1/3 credit, 1/3 commercial and industrial, C&I, lending, and 1/3 consumer assets. They've recruited over 300 new people to build out their commercial banking platform. The bottom line: Flagstar is moving in the right direction, but they're not out of the woods yet. If office and multifamily values continue to decline, they could still face serious liquidity problem. 2. Provident Financial Services. Assets: $25.19 billion. Credit to Tier 1 capital ratio, 430.1%. 3-year credit growth, 56.6%. Status: extreme risk. Provident Bank is currently carrying one of the highest credit concentration ratios among all U.S. banks. At 430.1% of Tier 1 capital, Provident is more than 4 times over the regulatory threshold. But it gets worse. Their construction and development, C&D, loans, which are even riskier than standard credit loans because they involve projects that aren't even generating income yet, equal 190.3% of their capital. That means if just a few large construction projects go sideways, if developers can't lease up the space, if costs overrun, if interest rates stay high, Provident could face massive losses that would wipe out a substantial portion of its equity. Why they're risky? Provident has been growing its credit portfolio aggressively, over 56% growth in just 3 years. That's a lot of new loans originated in a period when property values were already starting to soften. And their merger integrations have added complexity to their portfolio. 3. Bank OZK. Assets: $41.66 billion. Credit to Tier 1 capital ratio, 321.4%. C&D loans as percent of capital, 118.2%. 3-year credit growth, 20.2%. Status: high risk, well capitalized. Bank OZK is the heavyweight champion of construction and development lending. They're known on Wall Street as the go-to lender for large-scale, complex real estate projects. And for years, that strategy made them incredibly profitable. But in 2026, that specialization is a double-edged sword. At 321.4% credit exposure relative to Tier 1 capital, they're above the 300% threshold. And their C&D loans at 118.2% of capital are also above the 100% regulatory trigger for heightened scrutiny. Why they're risky? Bank OZK specializes in the kinds of projects that are most vulnerable to interest rate increases and economic slowdowns, large-scale construction that takes years to complete and requires continuous financing. If developers can't refinance their projects at maturity, Bank OZK could be forced to take possession of half-finished buildings in a soft market. But there's a silver lining: Bank OZK is better capitalized than most of its peers. Their Tier 1 leverage ratio is 13.77%, which gives them a bigger cushion to absorb losses. Management has also signaled that they expect the credit cycle to wind down in 2026 with an upturn starting in 2027. 4. Valley National Bank. Assets: $60 billion. Credit to Tier 1 capital ratio, 332%, down from 473% at year-end 2023. Status: high risk, improving. Valley National Bank is another institution that's been on a journey to reduce its credit concentration. At 332%, they're still above the 300% threshold, but they've made dramatic progress from the 473% level they were carrying at the end of 2023. Why they're risky? Valley National is heavily exposed to the New York metropolitan area. That means they're carrying a lot of loans on properties in a region where multifamily and commercial demand has been sluggish. Office vacancies in Manhattan and surrounding areas remain elevated, and rent-regulated multifamily properties face ongoing profitability challenges. What they're doing about it? The bank is aggressively reducing credit through strategic runoff, loan sales, and increasing their equity position. They're also diversifying into commercial and industrial lending, which now comprises 30% of their total loans. 5. Zions Bank Corporation. Assets: $88 billion. Credit exposure approximately 22% of loans, down from 33 to 34%. Total equity: $5.3 billion. Total credit exposure: $22.7 billion. Status: moderate risk, but concentrated in Western markets. Zions is one of the larger regional banks on our list, with $88 billion in assets. Their credit exposure as a percentage of loans has been intentionally reduced from 33 to 34% down to the low 20s over the past 15 years. Why they're risky? Despite the reduction, Zions still has significant concentration in Western U.S. markets. That means they're exposed to West Coast tech hub office vacancies and property devaluations. If office values in San Francisco, Seattle, or Los Angeles continue to decline, Zions could feel the pain. The bank has intentionally limited credit loan growth to 3 to 5% annually, which suggests they're being cautious. But caution may not be enough if property values in their core markets fall significantly. 6. Columbia Banking System. Assets: $50 billion. Credit loan concentration: 50.9%. Status: high risk, West Coast exposure. Columbia Banking System, which includes the former Umpqua Bank, carries significant West Coast real estate exposure. Their credit loan concentration stands at 50.9% of total loans, which is extremely high for a bank of this size. Why they're risky? With over half their loan book in credit and most of that concentrated in Western markets. Columbia is heavily exposed to tech hub office vacancies. The West Coast office market has been one of the hardest hit areas in the post-pandemic era, with remote work permanently reducing demand. Management has acknowledged the risk and is working to reduce inherited transactional loans, mostly multifamily, with about $8 billion expected to run off or reprice over 8 quarters beginning in the third quarter of 2025. 7. Simmons First National Bank. Assets: $24.26 billion. Credit to capital ratio: 355.2%. Status: high risk. Simmons First National Bank carries 355.2% CRE exposure relative to capital, well above the 300% threshold. Why they're risky? Simmons experienced rapid loan growth over recent years, which means many of their loans were originated at peak valuations. If property values decline, these loans could quickly become underwater. 8. Comerica Bank. Assets: $78 billion. Credit to equity exposure: 313%. Status: moderate high risk. Comerica carries over $78 billion in assets with CRE exposure at 313%. Why they're risky? Like many regionals, Comerica's credit concentration exceeds the regulatory threshold. However, they're on the lower end of the high-risk spectrum, and their larger size gives them more diversification than smaller community banks. 9. Synovus Bank. Assets: $61 billion. Credit to equity exposure: 373%. Status: high risk. Synovus Bank has CRE exposure of 373% of total equity. Why they're risky? Synovus is concentrated in the Southeast, which provides some insulation through faster regional GDP growth. However, commercial lending, especially credit, is sensitive to business investment cycles, and any economic downturn could hit them hard. 10. Umpqua Bank, now part of Columbia Banking System. Assets: $50+ billion. Status: high risk. Now merged with Columbia Banking System, Umpqua Bank has been identified as one of the banks with the highest credit risk, with exposure exceeding 300% of equity. As noted above, Umpqua is now part of Columbia Banking System, which means the combined entity carries significant West Coast credit exposure. Chapter 3: Why regional banks face more risk than Wall Street giants. Now, here's the really important part of this story. If you've been paying attention to banking headlines, you might have noticed something. The big Wall Street banks, JP Morgan Chase, Bank of America, Wells Fargo, they're not on our list of high-risk banks. Why? Let me show you the numbers side by side. The mega banks, JP Morgan Chase. Credit loans, $200.04 billion. Credit as percent of total loans, 13.2%. Credit as percent of total assets, 5.0%. Total assets, $4.02 trillion. Leverage ratio, 7.63%. Wells Fargo. Credit loans, $132.01 billion. Credit as percent of total loans, 13.4%. Credit as percent of total assets, 7.1%. Leverage ratio, 8.40%. Bank of America. Credit loans, $90.80 billion. Credit as percent of total loans, 7.5%. Credit as percent of total assets, 3.4%. Leverage ratio, 7.14%. U.S. Bank. Credit loans, $54.45 billion. Credit as percent of total loans, 13.5%. Credit as percent of total assets, 8.0%. Leverage ratio, 9.40%. The regional banks, for comparison, Flagstar Bank. Credit as percent of total loans, 57.1%. Credit as percent of total assets, 39.8%. Provident Bank. Credit as percent of Tier 1 capital, 430.1%. Bank OZK. Credit as percent of Tier 1 capital, 321.4%. The key difference: diversification. The mega banks have something that regional banks don't: massive diversification. JP Morgan Chase has $4 trillion in total assets. They're not just a real estate lender. They have investment banking, wealth management, credit cards, auto loans, commercial and industrial lending, and a dozen other business lines. If their credit portfolio takes a 10% hit, it's painful, but it's manageable. They can absorb the losses through profits from other parts of their business. But a regional bank with 50% of its loan book in credit? A 10% hit to that portfolio could be catastrophic. The regulatory asymmetry. According to research from JP Morgan and Citigroup, smaller regional banks are almost 5 times more exposed to credit loans than larger counterparts. This is a structural feature of the U.S. banking system. Regional banking system. Regional banks have historically focused on relationship lending in their local markets. For many of them, commercial real estate was the natural place to deploy capital. But that local focus becomes a liability when the local market turns sour. Delinquency divergences. Here's another fascinating data point from Q1 2026. The largest banks are those above $100 billion in assets and posted the only meaningful decline in credit delinquency rates, falling from roughly 1.9% to about 1.5%. Meanwhile, the $16 to $40 billion asset bucket saw delinquency rates rise the most. In other words, the big banks are getting healthier, while the mid-sized regionals are getting sicker. Chapter 4: The 2 triggers that could spark a crisis. So we've identified the banks. We understand why they're at risk. But what could actually trigger a crisis? There are 2 major catalysts that could turn this simmering risk into a full-blown banking crisis. Trigger 1. The refinancing cliff. The first trigger is the $875 billion refinancing cliff. As we discussed earlier, $875 billion in credit debt is scheduled to mature in 2026. Many of these loans were originated at interest rates of 3 to 4%. Today, borrowers are looking at refinancing rates that are 200+ basis points higher. Let's do the math. Old loan, $10 million at 4% equals $400,000 per year in interest. New loan, $10 million at 6.5% equals $650,000 per year in interest. Annual increase, $250,000. For a property that hasn't seen its net operating income increase by $250,000, that's a problem. For a borrower who owns multiple properties with multiple loans, that's a crisis. And here's the kicker: modifications and extensions are happening at scale. S&P Global estimated that the volume of loans coming due dropped by 16% between April and September 2025. That means banks are extending loans rather than forcing borrowers to refinance at higher rates. But extending a loan doesn't make the problem go away, it just kicks the can down the road. At some point, Those loans will need to be refinanced or restructured, and the longer we wait, the more precarious the situation becomes. Trigger 2. Plunging property valuations. The second trigger is plunging property valuations, especially in the office sector. Office values are still 20 to 30% below pre-2020 levels. In some markets, the decline has been even steeper. We're already seeing property owners walk away entirely, handing the keys directly back to lenders. When a borrower defaults on a credit loan and the bank takes possession of the property, the bank now has to manage and sell that property in a soft market. That's not a core competency for most banks. The problem is compounded by what the Federal Reserve has called a convergence of structural and cyclical strains in the credit market, including a downward shift in office demand due to hybrid work, high refinancing costs, valuation pressures, and high operating expenses. The perfect storm. When you combine these two, triggers a massive wave of refinancings at higher rates and declining property values. You get a perfect storm. Borrowers who can't refinance may default. Banks that take possession of properties may have to sell them at a loss. Losses eat into bank capital, and banks with thin capital cushions, like many of the regionals we've discussed, could find themselves in serious trouble. Chapter 5: The mitigating factors, why it might not be a disaster. Now, I want to be balanced here. It's not all doom and gloom. There are several factors that could prevent this from becoming a full-blown banking crisis. Factor 1. Banks are well capitalized overall. According to the Federal Reserve's June 2026 report, over 99% of U.S. banks are well capitalized by regulatory standards. That's a huge difference from 2008, when many banks were operating with dangerously thin capital cushions. Factor 2. The market is absorbing maturities better than expected. As one analyst put it, the market is absorbing CRE maturities better than expected. Loan modifications and extensions are happening. Lenders and borrowers are working together to find solutions rather than forcing foreclosures. And despite all the headlines, CRE loan delinquencies have stabilized at around 1.53%. Not great compared to pre-pandemic levels, but far from catastrophic. Factor 3. Lending activity is picking up. Year-over-year CRE loan growth reached 3% in the first quarter of 2026, up from 2.8% at the end of 2025. The four largest U.S. bank lenders each posted CRE growth of at least 5.5%, demonstrating robust sector momentum. Factor 4. Banks are actively reducing exposure. Many of the high-risk banks are actively reducing their CRE exposure. Flagstar has reduced CRE concentration from over 500% to about 365%. Valley National has cut from 473% to 332%. Bank of America has been the most aggressive, cutting non-performing CRE loans by 44% year-over-year to $1.2 billion while reducing credit loss reserves by $200 million. Factor 5. The Fed is monitoring the situation. Federal regulators are paying close attention to CRE concentrations. The Federal Reserve, FDIC, and OCC jointly proposed rules in March 2026 to overhaul bank regulatory capital. While these rules aren't specifically targeting CRE, they reflect a broader regulatory awareness of the risks in the banking system. Chapter 6: What this means for you. So what does all of this mean for you? If you're a depositor, first, let me put your mind at ease. Your deposits are safe. The FDIC insures deposits up to $250,000 per depositor, per bank. Even if a regional bank fails, your money is protected. However, if you have more than $250,000 in any single bank, or if you're a business with large operating balances, you might want to think about spreading your deposits across multiple institutions. If you're a real estate investor, if you own commercial real estate and have loans coming due in the next couple of years, you need to be proactive. Talk to your lender early. Explore modification or extension options. Consider whether you can increase property income to cover higher debt service costs. And be realistic about property values. They may not bounce back to pre-2020 levels anytime soon. If you're a bank investor, if you own bank stocks, especially regional bank stocks, you need to be very careful. The SPDR S&P Regional Banking ETF CRE fell 5% in a single session on March 2, 2026, a reminder of how sensitive these stocks are to CRE concerns. Some banks are more exposed than others. Do your homework. Look at CRE concentration ratios, delinquency rates, and capital cushions. If you're a business owner, if your business relies on commercial real estate, Whether as a tenant, a landlord, or a borrower, you should be aware of the risks. A wave of credit distress could lead to higher outro. So let's recap what we've learned today. First, the banks with the highest credit risk in 2026 are regional and mid-sized institutions, not the Wall Street giants. Banks like Flagstar, Provident, Bank OZK, Valley National, Zions Bancorp, and Columbia Banking System are carrying credit exposures of 300% to 430% of their Tier 1 capital, well above the regulatory threshold for heightened scrutiny. Second, the risk is driven by two major triggers: an $875 billion refinancing cliff as loans mature at higher interest rates, and plunging property valuations in the office sector and other commercial property types. Third, the mega banks like JP Morgan Chase, Wells Fargo, and Bank of America are well insulated by their massive balance sheets and diversified business models. They hold credit loans at just 5% to 7% of total assets, compared to 40% or more at some regional banks. Fourth, while the risk is real, it's not necessarily a crisis. Banks are well capitalized overall, the market is absorbing maturities better than expected, and many high-risk banks are actively reducing their exposure. If you found this video valuable, here's what I need you to do. Hit that subscribe button right now. We break down complex financial topics like this every week, and you don't want to miss what's coming next. Turn on the notification bell so you never miss an upload. Leave a comment below. I want to hear from you. Which bank on our list surprised you most? And what other financial topics do you want us to cover? Follow us on social media for daily updates on the biggest stories in finance and economics. Links are in the description. Thanks for watching. Stay informed, stay smart, and I'll see you in the next video.